Happy January, everybody. 2026 is in front of us. And today we're going to talk about our thoughts on this upcoming year. Stay tuned to this episode of The Den.
The Den, powered by the Lions Group, a show that explores trending topics in real estate, entrepreneurship, and personal growth. We're a small team of professionals with over $400 million in sales and nearly 2,000 successful transactions. You're listening to time-tested experts and industry leaders. Here's a refreshing look at real estate happenings and more. Welcome to The Den.
Hello, everyone. Welcome to this episode of The Den. And today we're going to give our forecasts for the 2026 real estate market. What can we expect? The good, bad, and the ugly. I loved that movie. But before we get into that, let me introduce my friends, my partners, my co-hosts, the fellow members of the Lions Group. To my right, Paul.
The ugly.
Yeah, Paul, the ugly, Hammy the Rockberry, Aspen, the Ninja Gruen, and the boss, Shannon Martin Martinez. My name is Ben, the Sea-Sayer Lions, and I'm here to see and say what I think the predictions are for 2026. Because not that I...
Soothsayer?
No, it's no Sea-Sayer. Soothsayer is probably right, but Sea-Sayer.
That's what we're rolling with today, Paul.
Yeah,
sorry.
See, I see and then I say, right? So yeah, and I can say that because I think I was at the bottom of the barrel last year with my predictions. So
you were not.
No,
it was Paul.
It was Paul.
That's how this is going.
Okay,
I better not lose this time.
You know what, though? One of these days it's going to catch up to me because I'll trash talk and then whenever it's something, I'm like, it's just a game, you guys.
It's just a game.
That's not that serious.
Yeah, why are we taking this so serious?
Well, you guys said that on the construction one. It's just a game. It's just then you get one and you're like, yes, I told you.
We just did an episode on 2025 and it was a pass year, right? We want to put that behind us. Don't cry over spilt milk. I do cry a little bit over spilt milk. I mean, I'm the guy that probably get a straw out and try to get it off the table.
Salvage whatever you can.
Yeah, you got to scrape it up into a little pile. But, looking forward, 2026, we have some big things coming down the line. I mean, we just had 3 interest rate cuts from the feds. But, Paul, does that necessarily equate to mortgage interest rates going down?
No.
Okay. So now that we've got that cleared up, it's going to be interesting to see. It's going to be interesting to see how 2026 plays out. A lot of people are saying that there's kind of a pent-up demand and that 2026 is really going to kind of blow up. But ladies, what are your thoughts? Aspen, coming to you first.
For the market in general?
Yeah, let's look at a national level and then look at a local level. Nationally, the experts are saying there's a lot of pent-up demand. I mean, we're, 4 or 5 million underserved in housing units in America. So there is demand. The supply is not there for the demand that's there, but interest rates have tamped that demand down. What are your thoughts for 2026? You think the demand is going to ramp up even more?
I do think so. One thing I've been thinking about is it's really hard to let go of those interest rates you got during COVID, but the amount of people that I've spoken to that have actually refinanced since then to get the equity out or people are just going to have to move. And it's been far enough now that I think people could say, I appreciated this interest rate, but I need to move or I need to do these things. Like if it's a year or two, you're like, no, I'll just stay here. I'll just make it work. And then a year goes by and you're like, okay, it's actually not working. We do need a bigger space. We do need, XYZ. We need to move to be closer to work. The commute's too long. So you can make something work for a while. And then I think eventually it just doesn't work as good as you thought it was going to. And it's like, what's worth it? You know what I mean? And it's like, okay, I'd rather pay more and not have this hour and a half commute or have my kids don't have to share these bedrooms or whatever it might be. So I could see that happening, but it might just take a little bit to let go of those interest rates.
Yeah, that's interesting, especially now. I mean, Americans are carrying more credit card debt than we've ever carried. And I think there's a lot of factors that play into that. So the fact that you're saying that a lot of people that you've spoken to that had these really low interest rates have refinanced maybe to probably consolidate some debt or something to that effect. That may be loosening the ship may be loosening up a little bit and ready to set sail. Shannon, what are your thoughts? Do you think that the demand is going to kind of break loose this year in 2026?
Yeah, I think that we're going to see things moving a lot more than we did in 2025. I think that we're getting a new Fed chair, and I think that's going to make a big difference. I think once those rates go down, you're going to see people moving again. They're going to be able to refinance, pay off some of that debt that they've occurred the last couple of years. They're going to be able to, make those moves on those homes, and it won't be as scary going from a 2 to a 6. It might be going from, a 2 to a 5 or a 4. So I do think all those things will come into play, and I think that'll get things moving again. It also might help too, with lower interest rates. I mean, then people, even, borrowing to build houses and purchase things are borrowing at a lower rate, which means we can bring it to market a little bit better. So maybe we'll start getting some more of that inventory. I think it when money, other people's money that you borrow is loose and easier to borrow, and it's more reasonable to borrow, you're going to see a lot more of it. And when you see that, you're going to see the movement.
Yeah,
that's when people are going to start moving again.
OPM.
Yeah.
Other people's money.
And we talk about this all the time. We talk about, like borrowing, when we talked about 50-year mortgages and things like that. You should always be leveraging other people's money.
Yeah. Yep.
But it comes at a cost. And when that cost is high, not a lot of it goes on. When the cost is low to leverage other people's money, a lot more of it takes place. But that's when things move.
How does that play though? I just struggle with, if I was a leader, with the Fed or on the national level, like anytime you pull a lever, there is just goods and bads.
Yeah, because you risk inflation.
Yeah.
I mean, you risk, also causing harm to
prices
the economy.
Going up.
Mm-hmm.
And that's the thing, Paul, I was just going to pivot over to you. If interest rates go down and all of a sudden we just see this influx of buyers, what does that do to the market?
We're still seeing more homes go on the market too. So I think it's going more towards an equilibrium. But if there's too many buyers and not enough homes, prices are going to skyrocket.
I also don't see that. Like, we're short so many homes that it would take a while to be there. I don't think, a 5% interest rate is going to be the thing that creates, where we don't have enough homes, or, or where we have too many homes. And, I just don't see that.
Well, I think you had talked about the low interest rates before. I think, I'm not moving. I think there's still a large percentage of sellers that are just going to stick and not sell, that might in other years sell. So I think, and the other thing that we haven't seen in a long time is the influx of foreclosures. They're still not releasing them at the rates that they used to. There's still a huge backlog of foreclosures.
Yeah.
So if they were to let those out, that would be a little bit of the supply problem.
Now, currently the foreclosure market makes up a really small percentage. I think it's like less than 3% of all sales are foreclosures. But what Paul is speaking to is a shadow inventory of foreclosures that are bubbling behind the scenes that the banks are getting their hands on and holding onto that inventory before they release it. We saw that a lot back in 2008, where banks had literally hundreds of thousands of homes and they would not release them. We would drive by them all the time and be like, why isn't this one back on the market? And it's because the banks didn't want to take a specific hit on any given quarter. They would spread them out over a couple of years. So instead of, selling the asset right then and there, taking a hit on the books and maybe gaining another $50,000 over what they could, they would just let it sit for a year and a half, 2 years, and that
just get dilapidated.
And they would take a hit down the road. It was pretty incredible. Those algorithms just didn't
what
make
also
sense.
they did though, which was interesting, is sometimes they did get run down because people weren't taking care of them. But a lot of times they were telling people, go ahead and stay in the home. We know you're not going to make the payments and we're going to foreclose on you, but stay in the home. Keep the utilities on. At least it was, it wasn't a vacant house, and they had a little bit more security there. And that was crazy. That happened in a lot of homes.
That's surprising to me.
Yeah.
I thought they'd go in and...
No, they weren't booting people out.
Yeah.
They knew, but they would say, we're just going to let it ride a couple of years and we'll let you know when we're ready for you to leave and foreclose on this, because they figured if someone's in there, it's safe.
I've got 2 customers right now that are doing that. One of them racked up $50,000 in forbearance.
Yeah.
The other one has been 2 years in the foreclosure process.
Yeah, they can walk
living there.
Yeah, they can walk out the door right now, and then the house is vacant. The bank knows they're going to foreclose on it. You may as well have somebody in there because at least the utilities are on. Nobody's breaking into it.
Yeah.
Somebody's probably watering the lawn a little bit and, at least for the most part, making sure there's not a leak in the house, I mean, even if they're not doing a lot of maintenance on it, they're making sure those major things are being taken care of.
Yeah, and that just happens
for livability.
when
They
it's
have to have
vacant.
it. Yeah.
When it's vacant, things like that happen. I'm working a short sale right now. Like, how long
We
has
haven't
it
seen
been?
that in years. I know. That's very surprising.
Yeah.
I've done a few pre-foreclosures lately, but we're just trying, the foreclosure prices that I have seen have been pretty crazy. They're so high.
Yeah.
Like they just don't
full market almost.
Full market for almost a rundown. I'm like, what is?
Yep.
Well, maybe it's just like what you said. They're just waiting to see and then slowly releasing. It's been very interesting.
Yeah. And then for a while, banks were actually going in and fixing homes up like flippers, which is pretty incredible to have a foreclosure that they go in and they hire contractors.
I think Michelle Martinez did that. I think she was going in and remodeling houses for foreclosed homes.
Yep, for the foreclosed homes at the bank's direction, which is pretty,
she was working with
pretty
the bank.
incredible.
Hi, I'm Ben Lyons, a partner at the Lyons Group. We're dedicated to making your real estate experience the best it can be. If you're looking to buy or sell, go to sjcbroker.com and watch our informational video series. These videos break down the process and shed some light on buying or selling. While you're there, schedule a private consultation with one of our partners. We'd love to sit down, talk strategy, and give you a real advantage in today's market. You deserve the best. So take those steps and we'll see you soon. Now back to the show.
So you think 2026, we're going to start to see some shadow inventory, some actual inventory hit the market with foreclosures. Is that kind of
I
your
hope
thought?
so.
Yeah.
I hope so. It would help.
Yeah. Free up the...
Yeah. Well, and we're seeing investors dump their portfolios right now. I'm seeing a lot of investors just say, I want to start over. I want to do something different. So those things are in the investor pool, changing hands at wildly overpriced. So if we could get foreclosures at decent pricing, we can start that whole...
That's interesting.
I haven't seen that.
Yeah. Why would investors, what are you seeing there with investors?
I have 4 different investors right now ready to just dump everything. I have one that's dumped 5 things.
And then
this
they
year.
want to buy more.
Yeah, they're just moving stuff around.
That's interesting because I feel like prices are high right now. So I would be nervous to let go of my other
they're
things.
getting, I think, the equity out of them. They've either flipped it or they put in what they want to. They've got it to a price that they can get out of it, and then they're going off and buying doing
so
other
my
things.
people are all holding. All my investors are.
Well, that's an interesting. I mean,
Maybe I've got the weirdos.
Well, no, I mean that's interesting.
I mean, it's interesting because if they did buy really good deals, 5-7 years ago, they put the money into it. They've got
Buy
a big
low,
equity.
sell high, right?
Yeah. And now it's still a time for them to sell, cash in the chips. Now they're going to buy high again, unless they really go into, which is the next talking point, into really deep multifamily, big units. You drive by these 200 unit apartment complexes. You're like, how do people afford that? Well, it's syndication. People have brought together investors to syndicate a deal and buy those. Well, that is coming up to what we're calling a debt wall in America. Those syndicators got those interest rates at 3%, 4%, 5%. And now they have to refinance because it's been their 5 years, their full 5 years, or very rare. You can go 7 years, but usually it's between 3 and 5.
That's what people don't realize with those commercial loans. They're not home loans.
Yeah.
They're very different.
And so you're going to see a massive turnover with big commercial complexes like that. So maybe they're setting the stage to be able to cash in low and then buy when that debt wall comes down on a big scale. So
maybe they're smart.
Yeah, maybe they are. Who knows? But I have more of the experience right now that most of the investors I'm working with are just, holding on to their asset, long-term play. We talked a little bit about this at last episode, but we have 1.5 million realtors in America. Do we see that growing, staying where it is, or decreasing? Shannon, what are your thoughts?
I think we're going to see a little decrease this year. I think we'll see a decrease this year because most people had a rough last year, but I think we're going to start picking up in real estate and they'll jump back in.
Yeah. Pretty incredible. Aspen, I know you shed some light on that. Your thoughts?
Yeah, I think we'll have a decrease too. I don't think it's going to be a mass exodus, but nationally, maybe we go from 1.5 to 1.4 or something like that. I think because it really is just not an exceptionally expensive business to hold. I mean, especially if you've been in a few years, you go independent. Yeah, you have to pay those fees to become your own brokerage, but then you really are only paying your yearly dues, and that's not sell a house.
Yep. And
Or even use it for your own.
Yeah, you
know.
buy your own properties, or buy or sell your own things. Paul, you were saying last episode, you think we're going to at least stay stable.
Here's what I would like.
Yeah.
Is at 1.5, you had talked about the top 15% sell more than 50%.
Yeah.
Let's let the rest of those go away and leave the business for the 15%.
Leave it to the professionals.
Yeah. So just step aside gracefully. We love you. Thanks for the help.
Oh my gosh.
But let us do the work.
Yeah.
So 26 will be better.
Yeah.
I don't know. I don't know if I was in the top 10 to 15% this year. So I'm like,
Well, I'm out of here.
What'd you say the bottom? Usually the stat is like the bottom 50% sold one house.
Yeah.
oh,
it was,
okay, never mind.
Yeah,
So we're okay.
Yeah, you're right.
I was like, oh.
We're like the top 5 or better.
Yeah, I actually think you're right. The lower 50% sold, I think, between I was an average between like 1 and 2 homes.
I know the average realtor sells like 3.5 homes a year,
Yeah.
like average.
That's pretty incredible.
Wow.
Yeah.
I mean, if they're big homes,
Yeah.
you never know.
Yeah. If you're in Miami.
Or you get one of those 200 unit. Let's stop messing around. Who won?
Okay. All right.
Wait, do we need to make our predictions, or are we gonna? How do you want to do this?
So well, no. Let's go through. So just for our audience, I went a year back, 1 full year. Oh, you know what? I forgot to say. Congratulations, Dan. This is 100th episode that we're doing right here. 100 episodes. Paul,
We should have done this way differently then.
I know. We should have kicked that off that way.
I was going to have poppers, and I was like,
Poppers,
do I want to clean that up afterward?
Right.
Yeah. So this is our 100th episode at the Den, and I'm super proud of us.
We don't clean our Thanksgiving stuff still.
We intentionally left that here so we could use it next year.
That's right.
Those are props, Paul.
Hey, guess what? You didn't fall for it.
I almost did, though.
Butt,
River's been doing a lot lately, so I'm sensitive to it right now.
So, well,
congrats.
Yeah. Congratulations to us for 100 episodes. Congratulations to you, audience, for listening to 100 episodes. It's been a rough road. So the first 99 were pretty tough. So just start. If you're starting here, you're in good.
We're going to get better.
Yeah,
that's almost 2 years.
Yeah.
That's not too shabby.
That's a workload for sure. So I went back 52 episodes and found our predictions, and I took some notes. So we make a bet every year. Who can predict the interest rate 1 year away at that time? Not the average for the year, but at that time, what is the interest rate's going to be 1 year from a year ago? And so, let me kind of read some notes here. Paul, we talked a lot about the market. You said there was no crash that was going to happen. There's going to be a leveling off with the appreciation. More inventory was going to come on board. So you're pretty right there.
He's right.
Yeah,
right on point.
All that sounds
Closer to an equilibrium. You're gonna. This is where Paul went off the rails.
Paul's like, I'm not giving a number. I'm just gonna.
You're gonna start seeing the Carvana type of purchasing coming.
Oh yeah, you did. You said it was going to be like all online. I forgot he
hit
said
a button,
that.
buy a house.
Eventually.
Okay. Maybe the seeds of that is what I was trying to help you.
I was trying to give Elon Musk some ideas.
Yeah. He was talking about drones and UFOs. Wait, that was me. Hedge funds, buying properties, and the push button to get a house. Your prediction. Well, let me just go through the rest of the notes here before we get to the prediction.
Holy cow!
Aspen was saying more.
That means I lost. That's what you did last year too.
More inventory coming up. Houses are not going to appreciate as rapid. There's a little bit of dip in value.
I probably said it first. You probably copied me.
Yeah.
I'm sure he just agreed.
Yeah.
Actually, Shannon probably said it first. We probably agreed with her.
You know what's funny is in that episode, Paul goes, and we used to say, I agree. So I agree. So he did say that. So more inventory coming up. Houses not appreciating as rapidly. A little bit of dip in values, which we did see in the Sun Belt states. More of a steady market because of the lack of inventory. Affordability is a concern, and a year of settling in. Shannon You said that the inflation is going to be, we're going to see some help with the inflation, which we did. Inflation has started to tail off quite a bit. Interest rates tick down a bit. It's a good time to still continue to look to buy. It was a seller's market then. You said it was going to continue, which we still are technically in a seller's market, but it is moving more towards an equilibrium. More things settling down. And you said not a huge shift, which was good. So, and I was talking about UFOs and aliens coming out and,
right. You're always off the rails.
but that's all right. So, so back then the average interest rate was 6.77% 1 year ago, 6.77%. Let's see here. I predicted 5.85%. I was really optimistic. I was an optimist. And we're not there. We're not at 5.85%. Shannon, on the other hand, said 6%. So you were kind of an optimist too. Aspen, a little more real with it.
I'm a cynic.
A little more real with it, 6.125%.
Oh, that's actually
That's close.
better than what I would have thought I would have
Right on
guessed.
point. Yeah.
Oh, I don't know what it is. I didn't look. I like to be surprised during those episodes.
Yeah. And Paul, the big cynical Paul, was at 6.3%. Now, I just Googled today, and there's a lot of different stats on what the current mortgage interest rates are today. And there's a little bit of a range, but I went off of Freddie Mac. And Freddie Mac has us at 6.22%. Paul, the grand prize winner.
Wow.
winner.
Yeah.
Chicken butt dinner.
Chicken butt dinner.
Aspen, number 2.
I'll take it.
Shannon, number 3.
Yeah.
And I'm sucking hind teat at number 4. So
Ben's buying lunch.
I'm buying
Again.
lunch.
I guess so, yeah.
Again, 2 years
I
in a
finally
row.
won something.
See, I'm a see-sayer. Right? I see things and I say, soothsayer. Come on, Paul.
No,
God dang.
if you had a better year than us, you should be buying lunch.
So that's fun. So now we've got to put forward our best guess on interest rates from a year from now. And let's go off for Freddie Mac again. I think that was a good way to do it. So we're going to refine this game a bit. Shannon, I'm coming to you first.
I'm going to be bold. 5. I'm going to say next year.
Wow.
I hope you're right,
I
Shannon.
hope
That
so
is
too.
not what I was going to say.
Holy
I'm going to go with
moly.
it. Mhm.
Good. Put it out there.
5.
Mhm.
I love that. You
This
just
administration's got some ambition, and they are pushing
driving.
it.
They're
And
driving.
let's see if they do it. I don't know if they will. I don't know if it'll be good
Yeah.
or bad, but that's
Wouldn't
the
say
impression
no.
I'm getting.
Wouldn't say no to it.
Yeah.
They've got,
Don't think it's going to be that way.
They do have
I'm
some
going to say
ambition.
5.
Okay. So Shannon planting the flag on 5%.
I'm doing it.
Whew.
I'm buying lunch next year, maybe, but I'm going in for it. Yeah.
Yeah. Go for it. I love
Yeah.
that. I love
It's
that.
called manifesting.
That's
That's right.
right.
That's right.
Exactly.
Bring it into existence.
And you're all welcome.
Yeah.
Yeah.
I know.
Thank
If it
you.
is, it's all you.
Thank you.
Administration, no way.
That's right. It was me.
Aspen, jumping to you. What's your prediction?
5.78.
Whoa, 578.
Yep.
It's kind of an interesting number. Okay,
I was
5.
going to do 5.75. I was like, whoa, that's too good.
Yeah,
Then I
yeah,
heard Shannon's.
yeah.
Your
Paul,
585 is speaking to me.
585.
Mhm.
So you're going to be you're going
It's
to
the
be
same drop I did last year.
Yeah, man. Okay, I'm going to do it. You guys are going to hate me for it. 5, 6, 7.
6, 7.
Oh my
Don't
gosh!
go there,
yeah,
Ben.
I know. You
I'll
know
do
that.
it.
Well, let's hope Shannon's right.
I have a bunch of preteen boys in my house right now.
yes.
It's all day.
Have you seen the
I
video?
have a teacher in my house, so she's like, no, I'll burn this
that-
place
yeah.
to the ground.
Did
Oh,
you-
we do it all day.
Did you see In-N-Out Burger? They banned the 6-7
Yeah.
ticket because the kids just go nuts when they call it. I'm like,
It's
oh, come on,
fun.
just let them do it. Yeah. It'll be over in a year. So, so 5, 6, 7. So here we go. We got a year ahead of us. What other things could we make a prediction on 1 year from now and see where we're at? You think our average sales price here is going to go up in San Juan County? What do you think about in La Plata County, Aspen?
Oh,
What's your
La
average
Plata?
sales price right now? It's like 855 or something.
Yeah, so it's different for like rural and out. So it is a pretty wide range, but I think in town Durango is like 850.
Yeah.
Yeah.
Right around 850.
Yeah.
Okay.
But then the rural one's like 585.
Poof. Okay. Big difference. Let's stick to San Juan County then. So our average sales price right now is about 315. Shannon, you're going to kick it off.
I'm going to say we'll probably stay steady.
You can say about 315.
Yeah.
Okay. You gotta say a number.
Oh, okay.
Yeah.
Okay.
So
But what is this bet for?
average-
Because lunch is for, we have to set the rules.
interest
Rates
rate
is
is
lunch.
lunch.
Okay.
Yeah. I'm still going to say 320.
320.
I think we're going to see the market start moving, but I don't think it's going to, soar the prices like it did in the past.
Okay. So 320. So a little hedge.
Mm.
Little hedge. And what is this for? What's the bet on this one?
Slap bet.
Slap.
What?
Just
You ever done a slap bet?
No.
Is that the
It's,
tortilla?
it's 3 slaps whenever.
No,
Yeah,
I would
right.
hate that.
Yeah, we're
I would
not
cry.
playing that.
Yeah,
we're not
yeah.
doing that.
I'm so sensitive.
Hey, we could do the water and the tortilla thing where you slap each other with that.
That is funny.
That's funny.
So ice cream. I think ice cream's the bet on this
Yep.
one.
Okay.
So we got lunch and ice cream. Okay. Aspen, we're at 315. Where do you think we're going to land?
So I was going to say the exact same thing as Shannon. So I'll pick a different one, but I'm only going to go like 325. But I even think that's high because I think we're going to stay basically the same this year.
Yeah. Okay.
We're kind of in a bubble. Like it'd be hard to go much higher unless there's like a bunch of higher end homes that sell
So,
Right.
and
yeah.
skew the numbers a little bit.
Right.
Well, and that may happen.
Yeah.
That may happen.
Yeah.
So, Paul, what are your thoughts there?
Yeah, I'm hoping. So here's my hope that foreclosures do come on the market, brings that bottom price down.
Opposite.
That'd be
and
nice.
we go down to about a 305
305. Wow.
because the numbers
Yeah.
have been going like this all year.
Mhm.
Yeah.
We've gone up all the way to 385 at one point.
Mhm.
Yeah. Well, I'm seeing a big push from Durango down to this area. And so I'm seeing a lot more higher end homes go under contract. I'm going to go the opposite. I'm going to say 329. So I'm going to go 329. And I know that's an optimist thing. So we'll see. We'll see. I've been wrong 2 years in
A
row,
lot.
so a lot. Trust me. So there you have it. I think we've got a good bet on the board for lunch and ice cream.
Well, I want to talk about, because we had a little discussion earlier about Zillow and the new court case that they have going. I think it will actually affect how they deal with agents. And you guys had a different take on that. So what do you think?
Do we want to save that one?
We
I haven't done any
we got 3
research.
minutes here, so we could shed some light on it a little bit.
What do you think?
Well, I think from what they're talking about, there's some big antitrust violations that have happened. And usually when you have those types of things, the powers that be come in and change how they do business. So if they continue with this lawsuit and they lose, there could be some major shifts, because right now they're trying to buy our buyers from us. They have access to our CRMs, all those types of things. They're pushing towards their mortgage company. So that could be an interesting change in the market from our end, not the consumer side, but from the agent side.
Well, and even from the consumer side, because the premise of the lawsuit is that consumers are being steered to their own, Zillow's trying to be a one-stop shop.
Yeah, they're trying vertical integration.
Yep.
That's what they're trying to do.
So you go in, you click a button, you want to see a home, well, you go straight to their realtor and their mortgage company through their CRM. And now all of a sudden, without you even knowing, you are in their ecosphere and you're hooked in there. And that's really kind of the premise, is that there's a lot of steering happening there, and it does create a monopoly. So
That's the thing, though, is like if they're providing like affiliated disclosures and stuff, though, then if people are all aware, I think that's kind of where it comes into.
Well, I think the thing that they're doing and getting caught with is incentivizing certain actions. So incentivizing using this broker and using this lender, then they don't have to pay any closing costs.
I mean, so do
Zillow
relocation companies, though. I mean, you don't have to pay the closing costs. I don't think incentives are new, but I can see what you're saying. Like especially when it comes to lending, I think that's where it gets a little bit.
Yeah, I think
I just don't know enough about it to have too strong of an opinion.
Yeah, I think we should do a whole episode of this, because I think the parties that are harmed would be the consumer that doesn't know that this is going on behind the scenes, and that they're being steered to a mortgage company that maybe not serving them in their best interest. And B, the people that are paying, the realtors that are paying into Zillow to get a fair share of their leads, and those leads are being separated off to the people that solely recommend their services. And so if you're just a normal realtor that's paying for this, for the lead service, then you're in a bad position, because if you don't recommend their services and they're listening to every conversation, AI is transcribing and telling them, giving them data. So it's a big thing. It'll be interesting to see, but we're winding down on time. Congratulations to 100 episodes of The Den. Thank you all for riding this roller coaster with me. It's been pretty wild. No one's thrown up yet, so that's good. That's good. We've had some
2026 will be the year of better nicknames for you.
That's right.
Right? Or worse. Lean in.
Yeah. We've had some screaming, some crying, but no throwing up, so that's good. Fantastic conversation, and we'll see a year from now how that all plays out. So if you like our content, please go to our YouTube channel, like and subscribe, and of course, go to sjcbroker.com and schedule a private consultation with any one of us here at the Lions Group. We'd love to sit down with you, whether you're buying or selling residential or commercial. We can give you an advantage in today's market. Thank you for listening to this episode of The Den. Till next time, we'll see you then.
Thank you for listening to this episode of The Den, powered by the Lions Group. Hit the subscribe button to keep informed, and check the show notes below for direct links to our buyer and seller video series. The buyer and seller video series can give you an inside track on taking the right steps in real estate. If you'd like to learn more about the Lions Group or to schedule a consultation, go to sjcbroker.com. Complex markets require complex strategies. The Lions Group can give you a true advantage in any market. Whether you're buying or selling, residential or commercial, contact us directly at sjcbroker.com. We're time-tested experts with a client-first approach, and we'll see you next time in The Den.